The markets are open and we're seeing a continuation of red, something we got a lot of in February, and we want to understand what is driving this and whether we should be worried. Now, if we look year to date, we can see overall for the S&P, it hasn't been that great, especially for the large companies like the Mag 7. In particular, we can see Nvidia down in 2025 at around 12%, and Tesla's lost around one quarter, down 26% of its total market cap. Amazon next to it down around 5%. As mentioned, the S&P has entered February with a drop overall, and this is due to economic as well as tariff concerns that we have been speaking about at least over the more recent period. But one thing that has been noted is, are we potentially seeing a stock market rotation as opposed to just a massive sell-off right across the board? And one thing's very interesting, when we do look at the different sectors, we have healthcare, value, basic materials. One thing is for certain, those companies that performed very strongly, like the tech in 2024, where they were up more than 35%, have performed fairly weak at least at the beginning of this year. And this is something that is shown through the numbers. For example, if we look at consumer cyclical, where they were up around 25% in 2024, year to date they're down around 6%. As we have, however, previously highlighted, February is the second worst month in the S&P over the longer term, September being the worst, but typically March should be a fairly positive. But right now it hasn't started in that direction. And another reason to support the overall rotation out of the Mag 7, what we are noticing in terms of their leadership and the proportion they take up of the overall index, it is starting to falter. In fact, when we look at the beginning of the year, sitting around 30 to 35%, we are noticing this is moving around the 25 to 20% region. One argument that maybe we are seeing more of a sector rotation rather than just a wide market sell-off. Yet when we take a look at the overall sentiment, one thing we can see when comparing it to historical performances, we are now entering what is typically a bearish scenario where investors are starting to get worried. We have seen valuations look incredibly high, companies trading well above their own historical figures, and as we have noted in previous episodes, this is nearly every single company. We're not just specifically talking about one sector, but if you look right across the board, many companies are trading at severe valuations that 5 years ago were much lower, and then maybe you could argue a correction is needed. The other thing that has been noted, it does seem to be just the US at the moment that is suffering. When we compare their index, which is pretty much flat, we see that the UK is up nearly 8%, with China outperforming both, up around 16%. So it is looking like investors, as well as some super investors who we have seen put a lot more money into Chinese companies, are seeing the US overall as an overinflated market. We also have news today which has sent the S&P a little bit lower, but then you could argue there are many reasons. One of them, though, that we have heard is that there was a weaker than expected reading on the US manufacturing that has got investors starting to worry that maybe we are going to see a larger impact right across the board. And to add on top of that, it is expected to have the first quarter of FY25 as negative GDP growth, and many investors are now believing we are starting to get a growth slowdown. But whilst the earnings hasn't shown that, it's not been reflected yet, analysts do like to look forwards, and this could be a factor. We also noticed that we're now sitting in the fear region. Just on Friday, we were sitting in extreme fear. So whilst investors, you could argue, are getting a little bit more confident, we are still sitting in a territory which is showing massive bearish sentiment. Now, depending on which analyst you like to look at, we have the Bank of America, who aren't surprised if we do end up with a 40% correction. We have Tom Lee, who is followed by many investors, and he is quite popular sometimes on CNBC. He sees that the S&P going up around 16% in summer 25, but then does anticipate it to start to come down by the end of the year, a 9.4% gain to the overall market. Then we move on to Goldman Sachs, who actually believe the wider market as a whole in 2025 is vulnerable. The way they see the whole situation right now is that they see the powerful rally that we have had in 2024 essentially pricing in all of equities for perfection, and if we do get any slowdowns in earnings, in growth, then we will see a very sharp correction. Whether or not the 40% that the Bank of America see, they do anticipate we are due for one, and in fact, very similar to Tom Lee's predictions, they believe the S&P in 2025 will return around 10%, and bear in mind they anticipate that to include dividends, so just on price return it will be slightly lower, and they see earnings as a whole start to come down 11% in 2025, 7% in 2026. And something that maybe isn't talked about as much is that many of the Mag 7 are looking to spend a significant amount of capital expenditures on artificial intelligence that have been well above what essentially analysts were predicting. We had Alphabet, who actually planned to spend around $75 billion in 2025. Analysts were expecting in the $50 billion region. We then have Amazon, who believe this is a once-in-a-lifetime opportunity. They're expected to spend $100 billion, which is the most out of all of the companies. We have Meta looking around $60, and then we end with Microsoft, who said just recently they are still looking at spending around $80 billion. So the worry investors are having right now is whether or not a strong return will be seen that can justify all of this artificial spending. And to make matters worse, the Microsoft CEO not too long ago came out and said that artificial intelligence at the moment is generating basically no value. So there are real reasons for analysts and investors to really think twice about the overall economy. But one thing we would say, there are always opportunities in the market. For example, if we just take a look at this screener, we can in fact notice there are many stocks right now in the market with some significant upside. So whilst we may see this as an opportunity to consider selling some of our stocks, or in fact just holding, there is also opportunity to buy severely undervalued stocks with lots of opportunities right across every single sector. Now, this is something we typically do by sending a free newsletter to your inbox every single Monday morning, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So you can click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks to consider in March, lots of information like the upside that Wall Street themselves see over the next 12 months, and on top of that, you can grab a spreadsheet of 32 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, sign up, and you can read straight away. If we just end the episode by seeing how the market is performing at the moment, whilst we do see some sectors looking fairly positive, we notice Nvidia down around 6%, in fact trading around $119. What we do want to remind you is some of the reasons why we are getting the pullback. We discussed growth concerns. If you remember, last year the US economy delivered a strong performance. Their GDP grew around 2.8%. However, just over the last few days and weeks, there have been some indicators that we may actually not get as strong as a GDP. In fact, we did just touch upon negative as well. And then we have policy uncertainty. Remember, Trump has said Canada, Mexico, and in fact China tariffs are ready to go just starting tomorrow. And we have big tech that is struggling very clearly. They are becoming, in fact, smaller and smaller in terms of the index. They have started to lag the overall S&P 500 as well. And finally, we have sentiment as a whole turning very negative. Right now, sitting in the fear. Last week, we were sitting in extreme fear, and who knows what the future will hold, at least in the shorter term. But overall, it is looking like a time to start to consider your overall portfolio, whether you believe some of your stocks are a buy, hold, or sell. But give us your thoughts overall, and as always, have a great day, and we'll see you all on the next one.